M. Ability to create a financial ratio analysis, such as debt, equity, account receivable days, liquidity ratios. Organizations rely on ratio-based evaluations to measure financial health, operational efficiency, liquidity, and profitability. The FPAC framework specifically includes debt-to-equity ratios, accounts receivable days, liquidity ratios, and other financial metrics as essential analytical tools for FP&A professionals. Financial ratio analysis helps organizations interpret financial statement data, identify trends, compare performance against peers, and support strategic decision-making. FP&A resources explain that ratio analysis transforms raw accounting information into meaningful performance indicators that help management assess operational strengths, financial risks, and long-term sustainability. Liquidity ratios evaluate an organization's ability to meet short-term obligations and maintain operational stability. Common liquidity measures include the current ratio, quick ratio, and cash ratio, which compare liquid assets against short-term liabilities. FP&A professionals use these metrics to assess working capital management, cash flow adequacy, and potential liquidity risks. Accounts receivable days, also known as days sales outstanding, DSO, measure how efficiently a company collects customer payments and converts sales into cash. High receivable days may indicate collection challenges or weakened cash flow performance, while lower values generally suggest effective credit and collection management. FP&A resources emphasize that strong liquidity analysis supports cash forecasting, operational planning, and financial risk management initiatives. Leverage and solvency ratios help FP&A professionals evaluate an organization's long-term financial stability and capital structure. Debt-to-equity ratios measure the proportion of debt financing relative to shareholders' equity, providing insight into financial leverage and risk exposure. Higher debt levels may increase financial risk, especially during periods of economic uncertainty or rising interest rates. FP&A professionals also analyze interest coverage ratios and debt service capabilities to assess an organization's ability to meet long-term obligations. FP&A guidance explains that leverage analysis supports financing decisions, capital allocation strategies, and investment evaluations by helping organizations balance growth opportunities with financial stability and risk tolerance. Profitability and efficiency ratios provide additional insight into operational performance and resource utilization. FP&A professionals commonly analyze gross margin, operating margin, return on assets, inventory turnover, and asset utilization ratios to evaluate operational effectiveness and profitability trends. Ratio analysis becomes particularly valuable when combined with benchmarking and peer group comparisons because it allows organizations to evaluate their performance relative to industry standards and competitors. Modern FP&A teams increasingly use business intelligence tools, ERP systems, and data visualization platforms to automate ratio calculations, monitor key performance indicators, and support real-time financial analysis. Technology improves efficiency, but finance professionals must still interpret results carefully and evaluate the operational drivers behind changing financial metrics. The FPAC finance professionals must not only calculate ratios accurately but also explain their business implications clearly and recommend corrective or strategic actions when necessary. Effective ratio analysis helps organizations identify financial risks, improve operational efficiency, optimize working capital, and strengthen profitability. As organizations increasingly rely on data-driven decision-making and continuous performance monitoring, the ability to create and interpret financial ratio analysis has become an essential competency for FP&A professionals responsible for supporting sustainable growth, financial discipline, and long-term organizational success.